All right, time now to get to the big story breakdown. With a slow news week here on Wall Street, the primary focus for many investors is on whether or not we will see a so-called Santa Claus rally. Ah, yes, our favorite time of year. Yesterday's price action put a bit of a damper in some of those Santa Claus rally hopes as the major averages erased all Santa Claus rally gains. Markets could also see more selling pressure today and tomorrow as investors look to dump some losing stocks for tax loss harvesting purposes. However, those losers may be hard to locate in your portfolio. Of course, major averages are looking at a third consecutive year of double-digit gains. Brian Jacobsen joins the show now. Brian is chief economist at Annex Wealth Management. Very happy New Year to you, Brian. Thank you for kicking off the broadcast with us here on the street. We actually have not seen a Santa Claus rally in a few years. We're coming off 2 years of losses. Do you think the market can turn it around and realize some type of Santa rally between now and next Monday?
Yeah, I think that you set it up really well in terms of recognizing that a lot of people take this time of year to do some of that tax loss harvesting. So you get a little bit of that selling pressure, but then where's the buying pressure? Because typically people want to rotate into what has been winning or, basically sit on their hands and not sell those stocks. But I think a lot of people are still trying to do that year-end cleanup of the portfolio, selling the losers, but maybe pushing it into cash. Biggest issue I think this year is just perhaps we opened our gifts a little too soon. And those valuations have people thinking that now maybe cash is a better alternative right now until we get into the new year.
Well, Brian, let's take a step back. You mentioned the selling pressure and the buying pressure. Where would the selling pressure be? I mean, I could see a lot of people maybe added crypto to their portfolio the last couple of months, and they're saying, oops. But otherwise, you look at the 11 sectors of the S&P 500, only 2 of them are down year to date. Real estate and staples, everything else is up.
Yeah, that's absolutely correct. It's been a great year so far in terms of the breadth of the advances that we've seen. So in terms of from a sector perspective, most of them are up. It's no longer just the case that it's just tech stocks and communication services that are really doing well. So it's more within each sector, I think, as far as where's are some of the losers that you can trim. Crypto is a really interesting one, especially from a tax loss selling perspective, because with traditional securities, you have this wash sale rule that you have to be careful with. And you might have to as well with some crypto, depending upon how you're investing in it. But for an example, something like Bitcoin, it might be treated as a commodity where you can effectively get the tax loss and you don't have to worry about the wash sale rule, which is just this rule that the IRS has where basically you can't buy it back within a certain period of time. But that might not apply depending upon how you're investing in it. So crypto, as is usual, might kind of march to the beat of its own drummer.
You mentioned tech and telecom. They are outperforming the S&P. So is industrials, by the way. Shares of XLI up better than 18% versus the 17% for the S&P. Let me get your take on metals, precious, and industrial. A rare losing session. It was this really dramatic reversal for gold and silver 24 hours ago. What do you make both of the record climb as well as a little bit of late year selling pressure, at least yesterday here on Wall Street?
I've been trying to wrap my head around what's been really driving it. And I think some of it is really you had the central bank buying of gold over the last couple of years that helped push the price higher, right? So you have more demand for it, somewhat limited supply, pushes the price higher. But then you suddenly get buying begetting buying. People recognize the trend in the price. So you get trend followers. Now it's at the point where it's like, well, what's the fundamental sort of thesis behind buying more of it at these price levels? We did have the announcement from China as far as limiting the export of silver out of Hong Kong. That's supposed to come in place on January 1st. So that might have been, in my view, perhaps the last gasp in terms of for this rally that we've seen with precious metals. And I would not be surprised if we saw some sort of retrenchment. I mean, we're so stretched from a charts perspective, from the technicals. I would like to see a little bit of backfilling to get a little bit more support. So I would not be surprised to see a little bit more of this downward pressure on precious metals across the board.
Brian, it's not just the Santa Claus rally, a few other fan favorite seasonal indicators to look for, not right now, but for the month of January, the overall so-called January barometer, and then you also have the first 5 trading days phenomenon, which oftentimes can tell us a lot for what the rest of the month and the rest of the year hold. How closely do you look at some of those seasonal indicators?
I love looking at them, but I think as we have learned, we can't bank on them. right? So you can learn on them or learn from them. With Santa Claus rally, we haven't had a good one since around what, 2021. And in terms of as goes January, so goes the rest of the year. As goes the first 5 days, so goes the rest of the month, right? These are really great things to really look at as far as the importance of flows. I think it's a healthy reminder that in the short term, the market can be driven by the flows as opposed to the fundamentals. And when we see an up 5 days for the first part of January, it's oftentimes led by those that people were doing that tax loss harvesting. So they kind of did that in October, maybe November, sat out for 30 days, and then they start adding those back. So I would not be surprised if we did see some of that buying pressure, especially with some of the small cap stocks, because traditionally that's where you've seen some of that repositioning at the beginning of the year.
Yeah, of course, historically, these indicators work until they don't, and oftentimes the year of the 4-year cycle they don't work just so happens to be the type of year we're coming into. That is, of course, the midterm election year. What is your 2026 outlook, and in what ways are you expecting the highly contested midterm elections next November to play a factor in terms of investor sentiment?
Yeah, I tend to be a little bit more, I guess, on the relatively bearish side for 2026 for the markets. I'm very bullish for the economy because I think we are going to see some of that stimulus kick in play as far as tax refund season, incentives from the one big beautiful bill for investing in property, plant, and equipment. So I think it could be good for the economy, but the market, I believe, has already priced in a lot of that goodness. And as a result, we might be setting ourselves up for a little bit of early disappointment where it's not really showing up as much or as soon as what we were originally hoping. Now, oftentimes in midterm election years, you see the market kind of languishing. You see some pullbacks all the way up until October. And then October is historically when you start to see the market begin to do that late year rally. I would not be surprised if we saw something similar because the vitriol out there from a political perspective is just going to get louder. And I think it's going to amplify some of the volatility that we could see in the markets.
Brian Jacobsen is the chief economist at Annex Wealth Management. Thanks a lot for kicking off the show with me today, Brian. All the best for the new year. Thank you.
Thank you so much. You too.